Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far 15 problems I have completed on financial management. Starting few problems I have completed on computing the return, expected return, average return. Then we have done the problems on computing the specific cost of capital, that is KD, cost of debt, redeemable as well as irredeemable. Now in this video, one more problem on KD I'll complete. Then after that we'll start the next, that is KP, cost of preference capital. So in computing the cost of capital, we have two stages. First stage, we have to compute the specific cost of each source of fund. That is cost of debt, cost of preference, cost of equity. Then next we have to compute the overall cost of capital or combined cost of capital or weighted average cost of capital. This is the procedure of completing the problems on financial management. So if you want the complete knowledge on the subject, on this topic of financial management, watch all the videos from beginning till end. Then only you can be able to understand properly. I'm putting my 100% effort in explaining each and every point in detail. Hope you are following, you are understanding. Now, before starting the 16th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take the screenshot of the next 6 problems I am going to complete in this video. Now, see the 16th problem. XYZ company has plans to issue 7,000 11% debenture of 100 each at a discount of 5%. So 7,000 debentures of rupees 100 each. So 7,000 into 100, 7 lakh. The total face value of all debentures 7 lakh, on which interest rate is 11%. So 11% of 7 lakh, you will get 77,000 interest, annual interest. And it is issued at a 5% discount. The debentures are redeemable after 4 years. N is equal to 4. So redeemable debt. And the commission payable to brokers and underwriters 32,000. These are the flotation cost. Remember, flotation cost will be deducted from face value to calculate NP, net proceeds. Calculate the after-tax cost of debt if the tax rate is assumed as 50%. T is equal to 50%. Assume tax benefit is available only on interest. This is the new point. In the earlier problems, we have multiplied 1 minus T after completing the formula. After completing the formula, we are writing into 1 minus T into 100. That means tax benefit is applied on all other items. But here specifically it is given tax benefit is applied only for interest, not for others. So after I itself, here we should write 1 minus T. Don't take 1 minus T in the last. That is the new point in the problem, because specifically it is given tax benefit is available only for interest. Right? That is the case. Now, XYZ company computation of KD after tax for redeemable, because period of redemption is given. I into 1 minus T plus RV minus NP divided by N divided by RV plus NP divided by 2 into 100. This is the formula for calculating KD after tax. So many problems we have applied. Now, I interest on debenture. 11% of 7 lakh, 77,000 is the interest, annual interest. Tax rate 50%, 0.5. Redemption value. At the time of maturity, how much amount the company will repay back to debenture holder. If nothing is given, face value. The face value of all debenture is 7 lakh. 7 lakh rupees. Net proceeds. Net proceeds is equal to face value minus discount, because debentures were issued at discount, 5% discount, and flotation cost 32,000 given in the problem. So face value 7 lakh, 5% discount. So 5% of 7 lakh comes to 35,000. And 32,000 is the flotation cost, brokerage commission, given in the problem. So 7 lakh minus 35,000 minus 32,000, 6 lakh 33,000. This is the net proceeds, NP. N is equal to 4 years. Now simply we substitute all the values in the formula. In place of I am writing 77,000. 1 minus T, 1 minus 0.5 plus 7 lakh RV, 6 lakh 33,000 NP divided by N, 4 years. 7 lakh plus 633 by 2 into 100. Simplify, you will get 4.14% is the KD after tax. This is the end of all the problems on specific cost of debt, KD. Now we'll begin the problems on computing KP, cost of preference capital. Remember, tax benefit is given only for interest charges. Tax benefit is not given for dividend. Dividend paid is an appropriation of profit. It is not an expenditure. So Income Tax Act will not allow as deduction for dividend paid. Whereas Income Tax Act will allow as deduction for interest charges. So interest is allowed as deduction. Dividend is not allowed as deduction. So there is no need of before tax and after tax. So 1 minus T we should not consider for KP, cost of preference capital. The formula is very easy, very simple, just like in KD. Now, see the 17th problem. A company raised preference share capital of 4 lakh by the issue of 10% preference shares of 10 each. The total face value of all preference share capital 4 lakh. The face value 10 rupees. Find out cost of preference share capital when it is issued at par, at 10% premium, at 10% discount. So under 3 situations we have to calculate the KP, cost of preference capital. What is the formula for KP? KP is equal to DP by NP into 100. It's very easy. DP by NP into 100. KP stands for cost of preference capital. This we have to calculate. DP stands for preference dividend. The rate of preference dividend is fixed. So it is given in the problem 10%. So 10% of 4 lakh is 40,000 is DP. Now case A, issued at par value. Par value means face value. So net proceeds is equal to face value. There is no discount, no flotation charges, nothing. So NP is equal to face value 4 lakh. So DP is equal to 40,000 DP. Here it is not DP, it is KP. KP is equal to DP by NP. DP is 40,000, NP is 4 lakh into 110% over. First case completed where preference shares are issued at par value, face value. Second, B case, issued at 10% premium. When the company issues the preference shares, it has issued at a premium. The premium will be added. The net proceeds is equal to face value plus premium. So 4 lakh plus 10%. 10% of 4 lakh is 40,000. So 4 lakh 40,000. So KP is equal to 40,000 is DP. DP remains same. The dividend on preference will always be calculated on the face value. So face value 4 lakh 40,000. So 40,000 divided by 4 lakh 40,000 into 9.09 is the KP. That's it. Now case 3, issued at 10% discount. At the time of issuing the preference shares, it is issued at a discount. So discount will be deducted. 4 lakh minus 10%. 10% means 40,000. 4 lakh minus 40,000, 3 lakh 60,000. That is NP. Now KP is equal to DP. DP remains same 40,000. Divide by 3 lakh 60,000 into 11.11%. That's all. This is the first problem on computing the KP, cost of preference capital, where it is irredeemable. Nothing is given, we assume irredeemable. When the period of redemption is given, it is redeemable. Just like debentures are redeemable and irredeemable, preference shares also may be redeemable, may be irredeemable. If period of redemption is not given, we assume irredeemable. This is irredeemable. Next, 18th problem. Problem number 18, you see. ABC Limited issues 10% irredeemable preference shares, specifically given irredeemable preference share, the nominal value of which is 100 rupees, face value. You are required to calculate the cost of preference share capital in each of the following cases. Two cases are given: issued at 5% discount and issued at 5% premium. Only two situations we have to compute the cost of preference. So calculation of cost of irredeemable preference share capital. KP is equal to DP by NP into 100, same formula. DP is equal to preference dividend, 10% of 100 rupees. How many preference shares are issued? Not given. Only one preference share face value is given. So we can calculate on one. The face value, nominal value of one preference share is 100 rupees and dividend is at the rate of 10%. So 10% of 100, 10 rupees. This is DP. This will be fixed. Now case A, issued at 5% discount. Discount will be deducted. So NP is equal to face value minus 5%. So 100 minus 5, you will get 95. Now KP is equal to 10 divided by 95 into 100, 10.53%. That's all. Case B, issued at 5% premium. Premium will be added to face value to get net proceeds. So face value plus 5%, 100 plus 5%, 100 plus 5, 105. So 10 divided by 105 into 100, 9.52% is the KP. That's it. This is the 18th problem. Now I am coming to the 19th problem. See the 19th. S and company is planning to issue 14% perpetual preference shares. We can call it as irredeemable or we can call it as perpetual, means same. Perpetual means continuous. No redemption period is given. Same formula, DP by NP into 100. Now with face value of rupees 100 each, flotation costs are estimated at 4% on issue price. So there is flotation cost and flotation cost will be deducted from face value to get NP. And compute the cost of preference shares if they are issued at par value, 10% premium, 5% discount. In three situations, we have to find out what is the KP, cost of preference. Now see carefully. Calculation of cost of preference share capital, this one 19th. KP is equal to DP by NP into 100, same formula. DP is equal to 14% of 100 rupees. The face value of each preference share is 100. So 14% of 100, 14 rupees. This will remain same. DP remains same. Now case 1, issued at par value. Par value means face value. No discount, no premium. But flotation cost is there. 4% on issue price. Issue price is 100 rupees. So 4% of 100, 4 rupees. 4 rupees will be paid. Deduct. So 100 minus 4, 96 rupees is the net proceeds. So KP is equal to DP. DP is 14. 14 by 96 into 100, 14.58%. This is the KP. First case completed. Now second case. Issued at 10% premium. Premium will be added. So 100 plus 10, 110. So issue price is 110. 100 rupees preference share is issued at 10% premium. So 110 is the issue price. On issue price, 4% is flotation cost. So 4% of 110 is 4.4. Specifically given on issue price, 4% flotation cost. Issue price is premium. So 110 into 4%, 4.4. 110 minus 4.4, 105.6. This is the net proceeds, NP. So KP is equal to DP. 14 divided by 105.6 into 100, 13.26 is the KP, cost of preference capital. Last one, case C. Issued at 5% discount. So discount will be deducted and flotation cost will also be deducted. So 100 minus 5% discount. So 100 minus 5 is 95. So flotation cost will be 4% of 95. So 4% of 95, it comes to 3.8. So 95 minus 3.8, 91.2 is the net proceeds. Now KP by DP by NP into 100. So 14 divided by 91.2 into 100, 15.35%. This is the KP. Completed. 19 problems completed. See the 20th. A company issues 10,000 10% irredeemable preference share, just like the previous problem. Irredeemable preference share of 100 each. Cost of issue is 2 rupees per share. Cost of issue, that means flotation cost, is given per share. So we calculate on per share only. We can calculate on total share capital or per share. We'll get the same answer because flotation cost is given per share. Calculate the cost of preference share capital if these shares are issued at par value or 10% premium or 5% discount. In 3 situations, we have to compute KP. Right. Now, see here. Calculation of cost of preference share capital. KP is equal to DP by NP into 100. DP is equal to 10% of 100 rupees. Always dividend will be calculated on face value. Face value 100 rupees. So 10 rupees is the DP. Now issued at par value. Case 1, case A. The preference shares are issued at face value, par value. So par value is 100 rupees. So net proceed is equal to face value 100 rupees minus 2 rupees per share flotation cost given in the problem. Minus 2. It is not given percentage. It is given 2 rupees per share. So 100 minus 2, 98. So KP is equal to DP by NP. 10 divided by, here 10. 10 divided by 98 into 100, 10.2% is the KP, cost of preference. Finished. First case completed. Now come to second case. Issued at 10% premium. So we add the premium. 100 plus 10% is 110. 110 minus 2 rupees is the flotation cost. So 110 minus 2, 108. So 10 divided by 108 into 100, 9.26 is the KP, cost of preference. Now third case, issued at 5% discount. Discount will be deducted. So 100 minus 5 is 95. 95 minus 2 is 93. So 93 rupees is the net proceeds. So 10 divided by 93 into 100, you will get 10.75%. That is the KP. That's all. So we have completed 20th problem. Now I am coming to 21st problem. Now from here onwards, we have redeemable preferences. Till now we have up to 20th problem we have completed irredeemable, perpetual preferences. Now we are having redeemable. So formula for redeemable debentures and redeemable preferences is same. The only difference is 1 minus T we should not take, and instead of I we should take DP. Instead of interest we are going to take preference dividend. So only you replace DP in place of I and don't multiply 1 minus T. That's all. That is the formula for KP. So 21st problem you see. Pravalika Limited has issued 10% preference shares of 100 each redeemable at the end of 10th year from the date of issue. So this point make it clear that these preference shares are redeemable. First time we are coming. Redeemable. The period of redemption is 10 years. Then the underwriter commission is 2%. These are the flotation cost. Then calculate cost of preference share capital. The face value is given 100. How many preference shares? Not given, and we don't require it. We don't require it. Flotation cost, commission, underwriting commission is 2%. So 2% of 100 rupees is 2 rupees. 2 rupees is the flotation cost. Now see carefully. KP is equal to DP plus RV minus NP divided by N divided by RV plus NP divided by 2 into 100. So what is the difference between this formula and redeemable debentures formula? There we have taken I, here we have taken DP. The remaining RV minus NP divided by N is same. There also we have, here also we have. And RV plus NP divided by 2, same. There in debentures, here in preference, same. Into 100. Don't multiply 1 minus T. That's it. Now first of all DP, preference dividend. The rate of dividend is given in the problem 10%. So 10% of 100, 10 rupees is the DP. RV, redemption value. At the end of 10th year, how much the company will repay back to the preference shareholder? Nothing is given. So face value. The face value is 100 rupees. The company will return back 100 rupees to preference shareholder. Then NP, net proceeds on issue. When the company issues the preference shares, the face value 100 rupees, but 2% flotation cost is there. So 100 into 2% is 2 rupees. So 100 minus 2, 98. 98 is the net proceeds. N is equal to 10 years, period to redemption. Now substitute KP is equal to DP. DP is 10 rupees. Plus RV 100, NP 98 divided by 10. 100 plus 98 divided by 2 into 100. So 10 plus 100 minus 98 is 2. 2 divided by 10 is 0.2. Divided by 99 into 100. So 10.2 divided by 99 into 100. 10.3% is the cost of preference capital KP. This is the first problem where we have applied redeemable preferences. Here it is irredeemable preferences. The only difference, if the period of redemption is given, it is redeemable. If the period of redemption is not given, it is irredeemable. That's it. So totally 6 problems I have completed in this video, from 16th problem to 21st problem. Inshallah, we'll continue the next problem in the next video.